Guys, today's video is about how to increase your borrowing power in 2021. By the end of this video, I'm going to share with you my 10 reasons why your borrowing power is lower than you expected and how to increase it in 2021.
Am I getting through to you?
And if you haven't already, hit that subscribe button and hit that bell icon. Number 1, reduce excess credit card limits. I was assisting Xavier and Jess with their borrowing assessment recently. They were wanting to buy their first home and needed $480,000 to make their dream come true. I calculated their ability, and unfortunately, the banks were only willing to lend $406,000. This was way off what they required. However, they did have a $12,000 credit card limit and were paying off the card each month. I advised if we closed the credit card, we'd be able to achieve the loan amount that they were after, which is $480,000. This is something we see all too often. Did you know that having a $10,000 credit card can reduce your borrowing power by as much as $70,000? Credit cards are one of the leading factors to reducing your borrowing power. This is because the banks take into account your worst case scenario when assessing your application. When you have a $10,000 credit card, the banks only look at what the minimum monthly repayments are if you'd fully use the $10,000 credit. They don't even take into account if you've never paid interest on the credit card. It's with this minimum repayment the banks calculate that reduce your borrowing potential. This is where you might consider closing a credit card prior to applying for finances. If you have a credit card with rewards points, it's important to take care when closing your card, as you might actually lose the points when closing the card. So be sure to cash out the points prior to closing. The key takeaways here are credit cards reduce your borrowing power. If you have a credit card, consider closing it or even reducing the limit. Tip number 2, all about the right lender. The amount a bank will lend you changes from bank to bank. We'd experienced this firsthand with Majid and Paul. They were wanting to buy their own home for around $805,000 and needed to borrow $610,000. The problem was the bank they banked with was only willing to lend them $420,000. The clients weren't able to make up the difference in what the bank would lend them and what they actually needed. They also weren't able to find anything they wanted in the lower borrowing. Luckily, they were able to secure that loan of $610,000 for a purchase of $805,000. This literally meant the difference between them being able to make the purchase become true and not. It pays to get a second opinion here. Each bank has their own credit criteria when assessing an application. For example, some lenders only take 80% of overtime income, whilst others might take 100%. This is only one example of hundreds of differences that the banks can have between each other. And it's with this difference that makes a drastic difference in what you can lend. The key takeaways from this is it pays to work with a broker to find a lender that can achieve what you want, as your borrowing power will change from lender to lender. Tip number 3, save more deposit. Hit that subscribe button if it's fair to say that the lending landscape is fairly complicated, and sometimes you might be closer to being able to achieve what you're after than you actually think you are. This was certainly the case for Jen and Mark. They were first homeowners and wanting to purchase for $525,000. The problem was they were so close to being able to lend what they required, they're literally only $22,000 off what they needed. When the banks complete a borrowing assessment, they take the customer's rate they're getting and then add a 2.5% buffer to determine what they could afford both now and if rates went up. For example, if the bank's giving you a rate of 2%, they'd calculate your borrowing assessment based on the 2% plus the buffer of 2.5%. So they work out if you can pay a loan at 4.5%. And this is the issue we had with Jen and Mark, was how the bank was sensitizing the loan repayments in their assessment. The original loan we needed worked out to be about 91% of the property value. The interest rate the customer was getting from the bank was 2.75%. So when the bank worked out what they could afford, they were adding their 2.5% buffer on top of the actual rate of 2.75, which is 5.25% when doing their assessment. We worked out if the loan could reduce by $6,000 to 89.99% of the property value, this would reduce the rate from 2.75% with the bank to 2.5%. This also reduced the sensitized loan repayments to 5%. This resulted in an increased borrowing power of $30,000. My key takeaways from this is having a larger deposit can increase your borrowing power. This is because the lenders sensitize your borrowing ability based on the rate that the bank will provide you, plus a buffer of 2.5%. When you have a larger deposit, the bank will provide you with a lower rate, increasing your borrowing power due to having lower sensitized repayments. Tip number 4, taking a longer mortgage term. The standard mortgage term in Australia is 30 years. There are some lenders out there that will give a loan term of up to 35 years. This increases your borrowing ability, as the longer the loan term is, the lower the repayments used when calculating what you can afford. It's worth mentioning that if you're going for the longer loan term, the total interest charge over the life of the loan is going to be higher due to you stretching the loan over a long period of time. We'd recently achieved a longer loan term for Zach, a first homeowner who is buying a property on his own. He had a great savings pattern and managed to save $100,000. The issue is his borrowing power was only $379,000 on a standard 30-year term. This limited his search for properties around that $480,000 when we calculated his deposit. He was happy to look at properties in and around that $480,000 and below. He was fortunate enough to stumble upon the perfect property that ticked all the boxes. The only thing was the property was going for $500,000, which would mean he'd need to borrow an extra $20,000. Luckily, we were able to find a lender that would give him a 35-year loan term, which increased his borrowing power for that extra $20,000. To offset the longer loan term, we set up the loan to allow unlimited extra payments, and Zach was going to continue to pay the loan based on a 30-year loan term repayment, which means he wouldn't be paying the loan off over that longer period of time. Tip number 5, paying out your HECS. The banks calculate your HECS debt on a minimum compulsory threshold that the ATO requires. As an example, if you're earning $70,000, the minimum compulsory repayment would be 4% of your income as a repayment per annum, which actually reduces your borrowing power by $45,000. As the ATO has a minimum repayment threshold, it doesn't matter if your HECS is $5,000 or $50,000, the way the bank calculates your repayment is all the same. By paying off your HECS debt, particularly if you don't have much left, you can increase your borrowing power. Tip number 6, reducing your debts. Secured car and unsecured personal loans reduce the amount you can borrow from the banks. It's best to work on paying off these debts to increase your ability to borrow. If you're unable to pay off the loan, the second best option might be to look at refinancing the loan to pay it off on a lower rate or even a longer term. If you decide to extend the term, do keep in mind that the interest you'll be paying will be more than you'd otherwise would by extending the term. You can eliminate this by paying extra repayments and continuing your same repayment that you were paying prior to making the change. This will give the bank peace of mind that you'll have the lower repayment when working out what you can afford. However, it allows you to continue to pay down the loan on the same repayment. Where possible, it's best to pay out and close debts prior to applying for home loans. This will boost your borrowing power and give you the best position to gain an approval. Tip number 7, property share. If you're looking to buy a property with a family member or a mate, that loan you've borrowed with them will weigh down your borrowing power in the future. There are some lenders out there that will allow you to cross-guarantee each other so that each of your loans can be in your own name. The beauty with this is that your loan will only be included as a liability in the future when calculating your borrowing ability. This will allow you to keep your borrowing ability intact rather than having to consider 100% of the loan in both names. Tip number 8, common debt reducer. If you're looking to buy a property on your own, in your own name, and you're in a de facto or married relationship, the bank will automatically default your living expenses to 2 adults, even if your partner is fully financially independent. The good news is there are some lenders out there that will allow you to reduce to 1 adult in your living expenses if you're looking to apply for the loan on your own, without your partner. The banks will require evidence that your partner is working and they're fully financially independent. However, this will have a massive positive impact on your borrowing ability. Tip number 9, increase your income. Finding ways to increase your income or get a second job is another way to increase your borrowing ability. Keep in mind, if you do get a side hustle, lenders require minimum history as 3 to 6 months for casual or even 24 months for self-employed, such as Uber drive. Tip number 10, cut expenses. Outside of your income and liabilities, the banks will look at your expenses, things like school fees, groceries, childcare. Reducing these costs will help increase your borrowing potential, whilst also helping you increase your money saved up. Hit that subscribe button if you didn't know that the banks look at the last 3 months of bank statements to understand your spendings habit. It's a good idea to keep an eye on your spendings pattern and even keep a budget. If your spendings are too low, the banks will default your living expenses to a minimum monthly benchmark. So drastically reducing living expenses to 2-minute noodles might not have a massive impact on your borrowing ability. So what's preventing you from qualifying for a loan? Here at Hunter Galloway, we get loans approved. So if you're living in Australia and looking for a mortgage broker, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065. We'll see you next time.